Hello, happy Thursday, and thank you all for joining. We had so much success connecting with clients and other colleagues in the industry with our monthly SEC ramp up to the SEC implementation date that we decided having quarterly discussions throughout 2023 would also be helpful. And sure enough, it seems like there's a lot to talk about. I am presenting without my counterpart and partner, Janice Kitzman, who is in Albany, New York, in the middle of February, attending a conference there with another one of our Cascade colleagues. So she's not with me today, but she will be back in May. And if you haven't joined us in past presentations, these roundtables are really meant to be informative, helpful, to the extent we get actual questions from participants and discussion going, the more the better. Two of my colleagues from Cascade, Jordan Berger and Leif Smucker, are taking your questions. I'm primarily focused on communicating, but I want to take your questions. I just am not that good at doing 3 or 4 things at the same time. So, but we're watching your questions, and we'll take them either as they come or toward the end of the presentation. So we do have a few prepared remarks, not just questions. Let's dig in some of the discussion highlights. For some reason, it's not working. Let's see. There we go. Okay. Discussion highlights today will, of course, be the SEC marketing rule and the recent Q&A. There are some pooled fund composite challenges that have already come up to us, and we've had to address during our first quarter verifications, and we're excited to share that with you, along with some more general challenges that have kind of been there all year: attribution, extracted performance, and then we'll close with a few mistakes that we're seeing. Very straightforward information, but should be some interesting information to talk about. Okay, let's jump in with SEC marketing rule with some context. Important. These are principles-based standards, and it can be frustrating at times because it's not as explicit. For those of you that are GIPS compliant, you know that there's some very clear prescriptive rules that are missing from this marketing rule. So I'm going to talk about fair and balanced. I'm going to talk about facts and circumstances in answering some of the questions that we have received, because the answer will be different based on different facts and circumstances. But you can always come back to fair and balanced and materiality as good guide rails to follow when answering these questions. One firm hearing the discussion today may go down one path, and another firm may take a different path, simply based on your appetite for risk. And so whatever you do, for everyone watching, I do think that what is going to help you more than anything is that you've really taken the time to document how thoughtful you have been in implementing this new SEC marketing rule. So for those of you that are GIPS compliant, you've already got performance policies. Obviously, every SEC registrant has a compliance manual that addresses some of the required RIA, must talk about, insider trading, must talk about testing personal securities reporting and things like that. So now you have some must address how you have implemented this rule, and spend more time, of course, on the areas where it's a little gray and what your reasons and justifications are for proceeding the way your firm decides to proceed. So that's the context that we all need to think about the SEC marketing rule, because when this new Q&A came out, a lot of law firms had to walk back some of their interpretations. And we're not attorneys here. We are in the performance. I've been in investment performance for almost 30 years, and sometimes that can be more informing than being an attorney working specifically in SEC regulations. This new Q&A, basically, I'm hoping all of you have read it. Maybe you've listened to a few presentations on it already. We're not going to spend a lot of time on it, but basically the question is, if you have a case study or maybe more than one, do you have to show the performance net of fees? And the answer is yes, you do. And to me, that was not a surprise. I didn't have to walk back anything because I know that a case study is very analogous to, picking a single security, which no advisor presenting a liquid fund is going to pick out one security and just show one security, a best without also showing a worst, for one thing. And then, of course, that's performance. And yes, you would need to apply your fee to it. But what's really hard, of course, is for private funds, it's hard to allocate fees because of the illiquid nature, the J curves of the investments, the time horizons involved. There are so many reasons why allocating fees to private investments in private funds, there are liquid private funds, of course, too, but certainly addressing the illiquid investments, it can be very, very difficult to allocate fees, and it's not very meaningful. And even the SEC in the proposed private fund rule says we don't think it's very meaningful to allocate fees when reporting to clients, but when reporting to prospective investors, prospective advertisements, it's required. And that's the simple answer is yes. So yes, you have to show it net of fees. Some attorneys had to walk back the guidance there. For me, what was really frustrating about this Q&A is that it didn't go one step further and address my big question, which is, what if it's not a case study? What if it's the deal level returns for all of your investments that the private fund is in? Is that okay to show those gross of fees if you have the net return on the same page for the total fund? Because you can do that. You can apply the fund net return total at the fund level and then showing the deal level returns. That's doable. But this question doesn't actually answer that. It doesn't go that far. To me, the fact that they didn't say it was okay does tend to have me leaning more toward that you really should apply some kind of a pro rata fee. And we're certainly seeing some firms do that now in their first quarter presentations and applying fees with some kind of methodology that requires a lot of assumptions to the individual case study or deal level returns. And could you apply that also to attribution? Maybe. Again, I believe that because this Q&A is addressing private funds, I think it was really intended to apparently address a lot of legal advice that was circulating in the industry that said as long as it was one case study and not multiple case studies, it was okay to show gross. And I was never there, so to me, it really didn't do that. But apparently, that's kind of where this came down and really impacted advisors showing private fund returns. I don't know that it needs to be extrapolated to composites of liquid investments, but we can certainly, depending on your appetite for risk, depending on facts and circumstances, certainly pull from it. I am definitely pulling that, net may be the way to go. If it's not impossible, it may just be the way to go, even on entire presentations of like deal level returns where you have the total and every single deal in the fund is included. That's probably the way to go, depending on your appetite for risk. Okay, I'm going to move on, but I will pause if there are questions. Just as a segue, the SEC did publish their priorities in February, I felt like it was really early, and it's normally usually in March, but definitely reference the marketing rule as a priority, especially for private funds. They talk about policies and procedures needing to address calculation of fees, and specifically fees and expenses for funds. So I'm just putting this in here to emphasize to you that, if this is GIPS, obviously for those of you that are GIPS compliant, this is super relevant. But even for those of you that are not GIPS compliant, this is a priority for the SEC, which we probably already knew. One very nuanced question that we got, and just before we kind of transition into some pooled fund considerations, something that could apply to all of you, whether you're managing separate accounts or pooled funds, if you show growth of $1 or growth of $1 million, is that hypothetical? And you may even say in your presentation that you have a hypothetical account of $1 million, but the answer is no. This is not hypothetical performance, because the performance results are actually encompassing all the related account portfolio actual returns. And so you just want to make sure, if you don't have the 1, 5, and 10 on there, as well as the growth of $1 million since inception, that you go ahead and reference that. And then some firms, what we're seeing is, if they did use the word hypothetical with this particular illustration of performance, that they've changed that, and they're saying, assuming an account of $1 million instead of a hypothetical $1 million. So straightforward, but a little insidious as CCOs are reviewing marketing materials, and you see that word. Very important now to be clear on whether that is or isn't hypothetical. Okay, so now I get to share with you my big learning curve since our summertime meetings. I can't believe I didn't see it before, but to be fair, when we first started talking about putting limited distribution pooled funds in composites, it was when the new GIPS 2020 standards were published, weren't even yet required. We're going all the way back to 2019, pre-COVID. It seems like a whole nother lifetime. And in that environment, we were asking our clients, do you want to create another report to give to limited pooled fund prospective investors? Or do you want to continue to use your composite report, but add some disclosures that disclose the expense ratios? And the GIPS standards allowed for either, as long as the pooled fund was in the composite, so they were being managed the same strategy. They had options, and we had clients that took both options depending on their own firm's business models, but we had a lot of clients that decided to just put it all in their composite and not create a new report. Some of those clients also had different choices that they made. Some just showed the composite report with the expense ratio disclosed to everybody, just so that they would only have one report. Some of our clients said, well, we're going to create 2 reports, and one of them will include the disclosure about the expense ratios when we're showing it to prospective pooled fund investors. And when we're showing it to separate account prospective clients, we'll just show them the one that doesn't include that. Lots of choices for GIPS compliance. Fast forward to where we are now, our first quarter of implementing the marketing rule, and our fees have to be relevant for the intended audience. The problem is that a lot of us, when we're making sure the fees are relevant, is we're just looking at management fees. And sure enough, the pooled fund management fees may be within the model return you're showing. They may be within actual net of fee returns, because you have larger accounts and big funds paying smaller fees at the management level. So it may have seemed to have passed all the tests, except when you realize, no, with a fund, it has to be net of all expenses. So you really need to be using the total expense ratio when you're trying to determine if your model fee is the right fee to show this to a prospective investor in the fund. This may not be an issue for you if your fund total expense ratios are at or lower than your model being used. But what we found during first quarter is that in fact, the total expense ratio was sometimes higher than the model fee being applied. And all of a sudden we're like, oh my goodness, we can't do this. So we need to be looking, we need to tell all of our clients and colleagues and professionals in the industry, be sure and look at that total expense ratio disclosure in your GIPS report, if you're GIPS compliant, and make sure that it is not higher than the model fee that you're applying. If it is, then you have a few options. You can change your composite net to be your total expense ratio, but that may make no sense at all for your institutional separate account prospective clients. You could add a column. We talked about that early in the summer, adding different columns that would be relevant to different people. I felt like the SEC examiner at the GIPS conference kind of poo-pooed that. Obviously, that was her opinion, not the opinion of the SEC, but she was concerned that having some net returns that were higher than others, just it created the ability for misleading maybe marketing to have both of those numbers there could enable them to mislead someone and point to the wrong one or something like that. Again, this is based on your appetite for risk. Finally, option 3, my favorite is, you know what, let's just create those GIPS pooled fund reports that we chose not to do. It's not that much extra work. And then you have performance that is relevant to those prospective investors specifically. A related question that comes into play is, what if you have performance-based fees, whether it's a fund in this particular question or even in a separate account? And this, we're not really talking about the difference between administrative fees and legal fees and accounting fees and management fees. Performance-based fees have always been required to be included in the effective fee test to make sure that fees are relevant. So since they're asking specifically about funds in this question, whoever submitted this question, we did get a few questions in advance of today's presentation, and we appreciate that. So we can talk about things that you actually care about. So we recommend a separate GIPS pooled fund report, option 3, from the previous slide. So it's just really clear. And then, of course, your performance-based fees are going to need to be part of that. What I will say is that you can still show your grossed up from admin costs, fund returns in your composites, right? I'm not telling you that you have to take them out of your composites. I'm actually just telling you that you can leave them in there, but that you're only going to show the composite returns then to the separate accounts, because that's the net return stream that is in fact relevant for them. And it would absolutely have to include the performance-based fees. But again, you can apply that on an effective fee level. Let me take one step back. I hope the terminology isn't too confusing. Effective fees come into play when, let's say, for example, and I'm going to use big round numbers, let's say your model fee is 1%, and most of your large institutional separate accounts in there are only paying 50 basis points. But let's say you don't have a minimum for this particular strategy, and you've also got some smaller accounts and they're paying 75, 80 basis points. And so then you have a fund, and your fund is paying somewhere more in the neighborhood of 60 basis points, but they also have performance-based fees. So sometimes their fee might be, with the performance fee, it might be 120 basis points. And you might say, ooh, that might be a problem if your model is 100. And the truth is it might be a problem, but it actually depends on the asset values of all of those different institutional accounts, the smaller accounts, the fund, all the market values, and you basically asset weight what those fees are to determine the effective fee for the composite. And that would be okay. It would be okay, again, to show actual returns if the effective fee is within that 1%. It should suffice. However, another reason why it's really good to have a separate, why we're recommending a separate pooled fund report, is because you want to make sure you're being relevant to the prospective investor. And yeah, maybe it passes the effective fee test, and maybe your total expense ratio even is less than that 1%. But as soon as you take into consideration the performance-based fee and the total expense ratio, now you're over and above that 120. So you were below it with just the, so it's a lot. It's a lot to test every, and then how often do you test it? Every quarter? Do you test it every year? We were always comfortable for the GIPS reports testing effective fees once a year, but if performance needs to be updated more frequently for the SEC, if it's changed, materially to the negative, then you might need to be doing these tests more often. Okay, enough about pooled funds and fees. Any questions on this before I move forward?
We do, Kim, we do have someone who wrote out a question about the slide prior.
Okay.
The question is, could you confirm that this is only applicable if a firm is using the GIPS report as a standalone piece of advertising?
Yeah, let's talk about that. So, I think it is obviously, if we're talking about pooled funds, you're going to have fund documents that are required to be shown, and maybe in those fund documents you've got NAVs, and so this GIPS report is just being shown with them. I believe if the net returns that are being shown are higher than your NAVs, and they're going to be, that this is not okay. So this is where facts and circumstances matter. The new marketing rule requires 1, 5, and 10-year returns, and they actually say in the rule that they understand you might want to show other time periods, and that's okay too. We just want to make sure you show these. So having GIPS reports with annual returns, and then pointing back to 1, 5, and 10, that's not an issue in terms of materiality, in terms of fair and balanced. It's fine. But when what you have in the GIPS report is a rosier return, it's a better return than what is actually relevant based on what the SEC considers a relevant return for a prospective investor, then I think it fails the test of fair and balanced. I think you're showing them something that's better, and you shouldn't be. I think you really need to create the GIPS pooled fund report, or at least a column showing that pooled fund return in the GIPS report in order to make sure that you're not showing something better on a GIPS report that you're handing to someone along with all of the fund documents. So unfortunately, no, I don't think this only applies to standalone. I think this applies to, this is where there is a confluence of what the SEC requires and what the GIPS standards require. Wouldn't it be lovely if you could just say, you know what, we're just not going to show our limited distribution pooled fund prospective investors a GIPS report? If you could do that and just show them all your NAV documents, your required articles and memorandums, and that'd be great. But if you claim GIPS compliance, you know you have to show prospective clients in limited distribution pooled funds a GIPS report. So now with the confluence of these two rules, with the returns needing to be relevant to that fund investor, with needing to show a GIPS report to that fund investor, I believe this issue applies whether you're showing the GIPS report standalone or with the fund documents. I'm not an attorney. If you want to build a set of policies and procedures that say, here is why, this is what we do to ensure we are following the marketing rule, and this is how we're implementing it, and you have an attorney that says this is fine, then I don't want you to change it on my account. I'm just sharing with you that we saw in a GIPS report a total expense ratio that was higher than the model fee applied. And we said, oh, wow, we need to be talking about this. So that's what we're doing. Okay, great question. Great question. One more Q&A talking about, get this, a standalone piece of marketing material. Different question than what you just asked, but this really had to do with whether or not the GIPS report needed to be updated by January 31st if it was shown within a presentation that does include updated performance through the most recent year end. And this is facts and circumstances, but it kind of gets back to exactly what I just said. And that is, you know, if it's just about 1, 5, and 10-year performance, then yeah, it's okay if the GIPS report isn't updated with the most recent performance by January 31st, if that's already somewhere else. And we recommend referencing it and referencing it prominently if you're not including it on your GIPS report. That just kind of has to do with, you know, is this whole presentation fair and balanced and meeting the requirements of the marketing rule? And we would say it does. Where it becomes an issue of facts and circumstances is what we have in the difference between 2021 performance in our GIPS reports. If you're not updating it with 2022 performance in February, and you're still showing a GIPS report with 2021 performance, which was very positive for almost every investment strategy, and 2022 performance is elsewhere in the presentation, and it is in most every strategy negative, now you have a fact and a circumstance where this isn't just about has it been updated. This is about stale performance that is much better in a standardized report, the GIPS report, than performance elsewhere in the presentation that goes through year end. So facts and circumstances, I believe an examiner coming into your office today in February, you clearly have performance through December 31st, 2022. Why aren't you putting it in this Word document? Because you don't have a pretty place to put it? And the answer, if you said, well, yeah, because it's not required for the GIPS standards, and our policy is we only put what's required for GIPS on the GIPS report, and you write that into your policies, then I still think that that there's some risk there if it's bearish. If it's bearish in the most recent year and you haven't updated it. Now, let's be optimistic and hope that in 2023, even first quarter 2023, that we have more positive performance. And certainly by the end of 2023, wouldn't it be nice if it was better than 2022, and then it took you 2 or 3 months to get your performance updated for whatever reason? You know, that's a different fact and a different circumstance, because now your stale performance is actually worse than the more updated performance. But I would say, rather than worrying about whether it's better or worse, just get the policies in place to make sure it's updated by January 31st, even if you don't want to add the table that you are now seeing, hopefully in more and more examples. We certainly had the tables in ours, and we've got one coming up. But if you don't want to add those tables, add the row. And firms have been doing this since the 90s, where they might add quarterly performance at each quarter end, just the performance. They wouldn't update annual standard deviation or dispersion or annual assets under management of the firm or the composite. None of that gets updated, but you can certainly update the performance column in a row for 2022 by January 31st. That would be another way of dealing with this without adding a whole table. And then you would know your performance at least was updated by January 31st. These are just our opinions. There might even just be my opinions and not everyone at Cascades, but I want to be helpful and I want to not, I would rather err on the side of being conservative than tell you that I think that this would be okay. It may not be a problem, and we put that in our answer. The GIPS report may not need to be updated with the most recent performance by January 31st. But you definitely want to reference where it is, and if there's a big difference between 2022 performance and shown elsewhere and the 2021 you're still showing, I would be prepared to get a question from an examiner about it. Okay, I'm going to transition now to some other performance challenges. What about attribution? Is attribution considered performance? So this has been a common industry concern since the marketing rule does not address it. It doesn't define attribution for us. It doesn't define or address performance statistics. It simply defines that performance is performance results of a portfolio. And then it both before and after fees. So it doesn't help us very much with these statistics. During the annual GIPS conference, they referenced, one of our speakers was from K&L Gates, and they referenced an article that K&L Gates had published about some of the open issues that we are quoting here to say that, oops, sorry, didn't mean to make the tiles move. Here we go. Because we don't know. Nobody has a crystal ball on where this is going to come down. So let's hope for a sweep exam that is then followed with some really informative interpretations from the SEC, letting us know what firms are doing that they like and what firms are doing that they don't like. In the meantime, this article has a very fair and balanced way of addressing this in that all attribution statistics are not the same, and they're kind of dividing them between statistics that are really clearly interpreting performance, especially through a risk lens. So if they're dividing by standard deviation, think of Sharpe ratios or information ratios, different. They're really taking that performance number and interpreting it so that it doesn't even really look like a performance return anymore, versus some attribution that is really demonstrating how well a fund has done. So think of excess performance, U minus a benchmark. That is, so it's a really good way of distinguishing between different types of attribution analysis and other performance statistics. And then just to give some examples of concerns, certainly minimum, maximum drawdowns compared to a benchmark, alpha, relative returns, excess returns, versus, as I mentioned, most of these ratios are divided by another variable, and so they don't even really look like performance. And then certainly, just while we're talking about statistics, standard deviation itself, which is not attribution, it's a statistic used to interpret performance, though, to interpret the risk of the performance. And so dispersion and 3-year standard deviations on GIPS reports, everybody's pretty much agreed, even though we don't have it in writing from the SEC, that those can continue to be shown gross of fees because it's a more meaningful number to not have it, to have those statistics clouded by fees being included. And it's not at risk of being misinterpreted by a consumer. So it begs the question, what about attribution tables? the performance attribution of every sector, every security and its weights relative to a benchmark. How good of a stock picker are you? How good were your duration calls in a fixed income portfolio? It's really a hybrid, and it's really a gray area. And I don't think that the new Q&A that the SEC just published about private fund case studies can be extrapolated to address this. But if anything, they're just simple, this must be net, kind of is informative. I'm not going to extrapolate. I still feel like this is an unanswered question, and it's very gray, because at the end of the day, anytime you're showing an attribution table, there's a lot of numbers there, and it's primarily used for interpreting performance. But at the same time, it is a number. It's going to show you outperformance in the technology sector or underperformance in, the financial sector or whatever it is highlighting. So it is a little bit of both. And I think again, it's not impossible. It's in some cases, it's meaningless to allocate fees across that, and it dilutes the value, but it's still valuable even if you have to show it net of fees. And it's not impossible. So it depends on your risk appetite there. It feels a lot like extracted performance, and the extracted performance, as we know, has to be shown net. The marketing rule did define that for us as performance results of a subset of investments extracted from a single portfolio. We talked about this at length, and just to clarify, especially if some of you didn't join us on some of the prior calls, one of the most confusing aspects of this new term is that it's not allowed to be the performance from a composite of multiple portfolios. And where this becomes particularly problematic is, there's a lot of portfolio accounting systems that aggregate and really create a single account with the composite returns. Some portfolio accounting systems will asset weight individual account returns to come up with that, but some just aggregate it. And the composite is essentially a single account then. And so could you make that case that, if I extract the equity returns from this aggregate account, is that okay? Taking a hard read, no, absolutely not. But could somebody build the case? Could someone submit a no action letter under these facts and circumstances? We're not trying to mislead people. And isn't it actually better to show the extraction of a whole composite rather than cherry picking a single account? And of course, our answer would be it's always better to show a composite than cherry picking a single account, even if you have the best of intentions, cherry picking one account to match a prospective investor, not to show your best performance. Of course, nobody on the call would do that. So this is just, important things to keep in mind. If you do show a composite sector, that the clear reading of the marketing rule is that will be hypothetical performance, and you need distribution limitations to only give that to people who can understand and interpret the results, and you need to have policies and procedures and disclosures, making sure this performance is really relevant for them. You could also just pick a single account from the composite and just make sure you apply net, because extracted performance has to be net of fees. And then the extracted performance disclosures are much easier. Basically, you just have to make sure that you are offering to provide the total return. So if you wanted to show, for example, your equity returns from your balanced accounts, and it could be country returns for a global portfolio. It could be all kinds of different ways of splicing and dicing and extracting something that is meaningful to share with people. In order to make sure you're not cherry picking, you simply have to offer to provide that total return promptly. And they don't address cash allocation. The GIPS standards make a very big deal of the difference between, and I'm just going to move to our example here. If you're showing this is an equity return for the composite that is being shown alongside, most firms always would show something like this gross of fees. So they have composite gross and net, they would show the sector gross. That clearly now needs to be a net return, and to be, if your appetite for risk is very low, you want to also make that of a representative account. You're going to have to call it supplemental. If you're a GIPS compliant firm, this would be a supplemental return, whether it includes cash or not, because it's a single account. So this is just an example. Any questions so far? This may be one of our more confusing topics because it really is apples and oranges when we start talking about GIPS standards, rules, and carve-outs and extracted performance and hypothetical, because they really don't line up. So where everybody can agree that if you have a single account managed with its own cash, that is going to be fine for the SEC to call it extracted. And as long as you're showing that net, you're going to be fine with the disclosure offering to provide the total return. So you don't have a problem there. But if you have a multiple account composite that you're carving out, now that's where it's real. We don't have an answer yet. No action relief would be super helpful. And then the GIPS standards would go one step further and say they would make a distinction between cash that is dedicated, and then in that case, it's not hypothetical for GIPS purposes, but if you're synthetically saying, we're going to allocate 5% cash to this equity carve out to replicate what an actual account might have, the CFA Institute says that's now hypothetical for their purposes. The SEC doesn't make that distinction at all, but the GIPS standards do. For those of you that are watching that are not GIPS compliant, cash has very little to do with this other than it's just something you need to disclose what you're doing. For those of you that are GIPS compliant, obviously it matters a lot to CFA Institute. What's not on here, but it's definitely something that we're seeing and having to encourage firms to really develop policies around is, what about if it's a single account carve out, but it's in a composite with other total returns? So what if you have an all total return equity composite, but you have a super large account that you carve out just the equity portion of because it's a balanced account, and you put that equity, and that is actually the primary length of your track record is that carve out, and it's your largest account in the composite. But now is that a single account carve out that can be extracted? Yes, but it's in a composite with multiple accounts. So does it feel like maybe for the period where there's multiple different accounts in there, even though they're total equity returns, is that okay? How much disclosure is needed? And how are you going to treat that? Again, that's facts and circumstances. It's not going to apply to everybody on this call, but you definitely want to think about things like materiality. You want to think about, how you're going to document your justifications for what you're doing. Any questions on this? Well, we have about 15 minutes left, and the good news is I'm really just at the point where I wanted to talk about a few common things that we're seeing, and none of this is rocket science, and it doesn't even involve too much terminology. There is an issue now with duplicate disclosures where firms are adding disclosures to be compliant with the SEC, but not necessarily deleting ones that are no longer relevant. And the first one that pops into my head is if you had percentage net of fee non-fee paying accounts in your net returns, but you've switched to model fees. You no longer need to talk about non-fee paying, take it out of the table, but you also need to make sure that your fee disclosures now don't talk about non-fee paying accounts, for example. The other thing we're seeing is firms are adding the 1, 5, and 10-year returns for the composite and the benchmark to their GIPS reports, but they're not adding some of the other required SEC disclosures in the qualitative area of the GIPS report. And again, if these are going to be issued as standalone, and only if they're going to be issued as standalone, it's going to be important to add those. And you need to make sure your policies line up, because if you're adding that table at the top, just in case it's going to be shown as a standalone, but you don't really think it's going to be, then you haven't covered all your bases if you don't have the required disclosures at the bottom too, because just in case it is handed out as standalone, it would need to have them. Very similarly, many firms used to include a performance commentary, or not even a commentary on the quarter, a quarterly commentary, and performance didn't always make it into that commentary, but sometimes it would be something firms would like to highlight. So very sporadically, you might see a portfolio manager talking about performance because it was remarkable for that particular quarter. And that was never an issue from a GIPS compliance concern because that is outside of the GIPS report. For the SEC marketing rule, though, that mention of quarterly performance now requires firms to show 1, 5, and 10. If that's being distributed as a standalone commentary, you need to also be putting it with a fact sheet that's got your 1, 5, and 10-year and all your SEC disclosures, or a GIPS report that has all of those. And then as far as internal documentation, we are seeing, marketing materials updated. We're seeing disclosures updated. Sometimes the policy manuals, though, when we get to those, we're seeing that they're still describing, they might still be describing how actual net returns are being calculated, even though the firm changed to model, for example. So I think that is, just it requires another read through your GIPS policies. And really, when things change as of a certain date, taking the time to be sure and disclose the timing of that, how things were treated before and how things are treated from that date forward. And of course, a nice solution for all of this is be sure and engage your compliance consultant or your verifier, or and they'll review documents as you change them. And you can engage your attorney too, but obviously they're going to charge you by the hour. So you might want to work with a consultant who wants to just be helpful. We have a deliverable. I respect attorneys. I'm married to one. They charge by the hour for a reason, because their advice is very often their deliverable, whereas our deliverable is the testing, the verification letter that we have tested compliance, and the consulting just helps us help you get to a place where we can issue that deliverable. So it's a very different business model. I absolutely value attorneys' their perspective, and hope that nothing on my discussion today would lead any of you to think otherwise. But they don't have a crystal ball any more than we do. Any other questions that you'd like to address in the last 10 minutes of our quarterly roundtable today? Doesn't look like it. Well, thank you again. We'll be doing this again in May. In an ideal world, we'll at least have another Q&A from the SEC to discuss. We'll certainly have completed a lot more annual verifications, post-marketing rule, and if we have a lot more questions from you, it will be a productive, purposeful dialogue, and we hope you tune back in and join us. Thank you.